Let's stick with equities now and bring in John Petrides, portfolio manager at Tocqueville Asset Management. John, not a lot of action today here in the market, but I'm curious where you're putting your money to work at the moment.
Yeah, well, I think that when you look at the whole spectrum of where to invest your incremental dollar, you have stocks, bonds, cash, and I guess now cryptocurrency. And when you go down the spectrum, bonds, you have interest rates at your face. So when interest rates go up, bond prices go down. And regardless of when the Fed is talking about tapering or will actually taper, with the economy reopening, interest rates are most likely going up over the next 12 months and beyond. And the Fed has even said that by 2023, they want to start raising interest rates. So that makes, owning bonds a bit more difficult in your portfolio. If you're fearful of inflation, well, why would you own cash? Inflation erodes the purchasing power of your cash because you're not earning anything on that cash currently. So sitting in cash really doesn't do you any good. If you have the stomach and the time horizon to handle cryptocurrency, well, then, maybe there's a play there with the recent sell-off. But bottom line, stocks look to be the best place. The underlying fundamentals of company earnings are really strong. The E in the price to earnings multiple, the PE multiple, continues to be exceeded by company earnings results, which makes the valuation cheaper than what it looks like on a static basis. So if you stick with finding really solid companies with solid fundamentals, I think buying the dip or dips within a market during the course of market sell-offs still makes sense here for investors.
So, John, I believe it was just yesterday. I can't remember. My memory is going. But we were told just yesterday that there was already a taper tantrum in the markets. Curious to know if you also see it that way. And if not, how are the equities going to react to that tapering and that scaling back of economic support?
Yeah, it's a good question. I do think that when the Fed announces their plan, listen, we have the next Fed FOMC market meeting in about 3 weeks from now. And during that call, I do hope the Fed says something more than we're thinking about tapering. I do hope they put forward some plan because more than 50% of the United States will be vaccinated by that point in time. All the economic data is pointing to up and to the right. The banking system is very healthy. Corporate America is very healthy. The consumer is very healthy. Why do we still need to be in crisis level monetary policy? So I'm hoping that the Fed gives us more guidance on what the next steps are. And could there be some volatility in the stock market? Sure. It's not uncommon for the stock market to sell off 5 to 10% from peak during any calendar year. But the underlying fundamentals for stocks is still strong. And even if interest rates do go up and the Fed does taper, the cost to borrow money is still very cheap. The 10-year is still 1.6%. Even if the 10-year reaches 2%, that's still very cheap relative to historical averages. So I still think the setup for the stock market is strong. And the biggest wind at stock investors' back is that there's about $4 trillion of cash sitting in money market funds earning nothing. So that's just waiting to pounce on more attractive investment opportunities, in my opinion. And I do think that provides underlying support as the Fed starts taking the punch bowl away.
And speaking of those opportunities, I know that you, like one of the laggards of last year, you think energy is undervalued right now. Make the case for that. Anything in particular that you're looking at there?
Yeah, so I think I need to caveat it a little bit with that finding yield, finding income in this environment is really difficult. So because spreads have tightened so much on high yield bonds, investors are no longer worried about stock companies cutting their dividend. You can't find yield really anywhere. As I mentioned, if you go into longer dated bonds or higher quality bonds, you're not really picking up any yield at all. So, with the underlying economy coming through, with E&P energy companies really cutting their capital expenditure budgets dramatically from last year when OPEC turned on the spigot to flood the market with oil. So they're not producing as much. It makes for a tighter supply-demand situation on the energy side. And one of the names that we own in our enhanced income strategy, which is the goal is to get more yield than a bond, than a fixed income portfolio with less volatility than a stock portfolio is Chevron. Chevron is one of the highest quality E&P companies out there. It has one of the strongest balance sheets, and you're getting over a 5% dividend yield. They bought Noble Energy really for very little, at part of the trough of the energy market last year. And they're a management team that's extremely focused on optimizing capital allocation for shareholders. So as long as OPEC, which is the true wild card in the energy situation right now, doesn't come in and decide to flood the oil market again, I still think Chevron, which has about a $50 break even on the price of oil, is a safe way to play the rebound in the energy markets and pick up income.
All right. Just want to make clear for disclosure purposes, you own Chevron there in your portfolio. John Petrides, portfolio manager at Tocqueville Asset Management. Thanks as always. Good to see you.